Welcome to the Deep Dive. Today, we're opening a file on an event that, well, it was pushed aside pretty quickly. The mainstream financial press, they filed it away as market volatility or maybe healthy profit-taking.
Right, the usual excuses.
But once you really start to peel back the layers on the sources we've compiled for you, the story is, it's much more unsettling.
It is, because this wasn't just a correction. It was a targeted structural intervention.
A raid.
That's the core thesis we're pursuing today. We are dissecting that astonishing and just unbelievably abrupt crash in the silver market, the one that happened on December 29th.
In just a few hours.
In a few hours, silver prices plunged a staggering 11%. And while the headlines might have mumbled something about macroeconomic fears, they completely, and I think intentionally, ignored the mechanism of the move.
And the mechanism is the whole story.
It's the only thing that truly matters here.
Okay, so let's unpack this with the core idea that our sources really hammer home. If we think of the market as a game, as a competition, this wasn't a fair loss.
Not at all. It was a fixed fight.
It was a fixed fight. And the analogy that just keeps coming up is perfect. Imagine you're playing a high-stakes game. Let's say it's poker.
Okay.
You've been playing for hours, you've secured the best position, and you are dealt the winning hand, the royal flush. So you push all your chips, all your hard-earned capital, right into the middle of the table you're about to collect.
And on the other side of that table, you have the commercial banks, the Wall Street giants, and they have this sudden, sickening realization. They are about to suffer a catastrophic loss.
An unrecoverable loss.
Yeah.
Exactly. And just as you reach across the felt to rake in this massive pile of winnings, the casino boss, the guy who runs the whole establishment and, crucially, writes the rules, he walks over.
And that's the exchange, the CME Group.
That's the CME Group. He blows a loud whistle, stops the entire game mid-hand, and announces a rule change.
Right there on spot.
On the spot. He looks directly at you, the retail player, the one who used leverage to get into this winning position, and he says, new rule, effective immediately. To stay in this hand, you need to instantly double your security deposit.
And of course, the retail player who's maximizing their leverage, the one with, say, $20,000 controlling $400,000 worth of silver, they don't have an extra $20,000 just sitting there, liquid, ready to be wired in an hour.
Of course not. The system is designed to catch them right at that moment.
Exactly.
So what happens? The bouncer, and let's call him the margin call, grabs you, tackles you to the ground, and forcibly drags you away from the table.
Wow.
Your position is liquidated, and your winning hand, your pot of chips, it goes straight to the other player, the commercial bank, at a huge discount.
That, in a nutshell, is the story. That's the December 29th silver crash. Our sources frame it not as a sell-off, but as a structural robbery.
Orchestrated by the referee himself.
The indignation is, I think, completely justified. This was an engineered flash crash, and it was rooted in pure desperation.
So our mission today is very specific.
It is. First, we need to understand the exact mechanics of what the sources call the regulatory intervention, or what we're calling the margin hammer.
Right.
Then we have to investigate the motive, which is just undeniable, why this was timed so perfectly to save the bank's short positions.
And then the proof.
And then we'll present the irrefutable global evidence, the Shanghai divergence, that proves this was purely a paper event. It was totally disconnected from physical reality.
Okay, but hang on. Let me just play devil's advocate for a second, just to be fair.
Please.
If the silver market was seeing, crazy volatility, if the price action was so aggressive that it was threatening the stability of the entire exchange, wouldn't the CME be justified in raising margin requirements, just for risk management?
That's the perfect question.
How do we prove this was malicious and not just prudent?
The answer is all in the timing and the target. Risk management is proactive. This was reactive. Our sources show the margin hike wasn't some slow, reasoned adjustment. It was a sudden, massive increase, and it was enacted just 48 hours before a critical options expiration date.
The timing.
The timing is everything. The move specifically targeted the ability of leveraged speculators to hold their positions long enough to get that payout from the banks. Prudent maintenance doesn't usually involve bankrupting one side of a trade to save the other at the last possible minute.
So that connection.
Yeah.
The rule change and the options wall liability. That's our smoking gun.
That's it. We're looking for structural intent. Because, as our sources make crystal clear, solar panels didn't suddenly stop needing silver. Industrial demand didn't just vanish overnight.
And China didn't start dumping metal on the market.
Not at all. The only cause for that 11% drop was the CME Group raising the security deposit. So we need to empower you, the listener, by understanding this predictable playbook. Because
Wow.
if you trade paper contracts, you are in their casino, and they reserve the right to change the rules anytime they're losing.
Okay, let's start by framing the crime itself. Because when thousands of traders woke up on December 29th, they found their trading platforms had just sold their positions automatically
Without their consent.
without their consent. This was a massive, sudden, forced liquidation event. The media called it a correction, or maybe a cascade of stop losses.
Right.
We're calling it a raid because they didn't fall out of the trade. They were kicked out. An external force pushed them out.
And that feeling of betrayal, it comes from the fact that they weaponized the very system that allowed these retail speculators to even participate in the first place. Leverage, specifically through futures contracts. To really get the impact of this rule change, you have to understand the risk, the inherent risk in the financial weapon they used against you.
So let's define leverage, not just simply, but deeply. When you buy a futures contract on the COMEX, you're not buying physical silver.
Yeah.
You're not even buying a receipt for the metal. You are buying a contractual promise, a promise to buy or sell it at a future date. And that structure, it allows for massive leverage.
Lets you control a huge asset value with a tiny amount of cash up front.
And our source material gives a really concrete example to show the scale.
Yeah.
A single futures contract for silver lets you control 5,000 ounces of the metal.
5,000 ounces. So if silver is trading around, say, $80 an ounce, that one contract controls $400,000 worth of silver.
400,000. But here's the toxic beauty of the system, as you said. You don't need $400,000 in your account.
Not even close. That initial required deposit, that's what's known as the margin.
And let's use a scenario from our sources, one that's really common among retail speculators who are trying to maximize their gains. You might only need to deposit, what, $20,000?
$20,000 to control that $400,000 worth of metal.
That's a leverage ratio of 20:1.
20 to 1, which means you stand to gain or lose 20 times the capital you actually put up. When the price goes up 5% in a week, you've made 100% on your cash. It feels incredible.
It sounds amazing.
But that 20 to 1 ratio creates immediate systemic fragility. The margin deposit isn't just a fee, it's a security blanket for the clearinghouse and the broker.
Right. It's there to cover losses if the price moves against you.
Exactly. It's there to cover the initial movement before you default. But, and this is the absolute key, the margin is dynamic, it's adjustable, and it's set entirely by the exchange.
And now we get to the moment of intervention. The CME's ability to just change the rules mid-game. They set the rules, supposedly based on market volatility.
Right, volatility. Though we know the real motive here.
So the exchange decides the required deposit isn't enough anymore because of rising price risk, and they dramatically raise the required amount. This is the margin hike.
Let's run the math on the immediate impact. If the CME raises the margin requirement by just 25%,
Okay.
so it goes from $20,000 to $25,000 overnight, what happens to that retail trader? The one who was aiming for maximum profit and only had the absolute minimum of $20,000 in their account.
They're instantly non-compliant.
They instantly cease to be compliant with the exchange rules. On paper, they become immediately insolvent.
Instantly insolvent, just like that. The goalposts were moved, and now they're on the wrong side of the law simply because the exchange printed a new law overnight.
They did nothing wrong with their trade. They just obeyed yesterday's rules.
And this is what triggers the dreaded margin call.
That margin call is not a polite request. It's an ultimatum. It's delivered automatically by the brokerage firm, which is on the hook to the clearinghouse to maintain that margin.
So the message says you have to wire the $5,000 difference now.
Immediately. And the sources highlight that the deadline is often brutally short, sometimes just 60 minutes. You're not getting T+1 settlement. It's now.
And that's the reality check. That's what exposes the system as being rigged against the little guy.
Absolutely.
I mean, how many people, even sophisticated traders at home, have $5,000 liquid, cleared, and ready to be instantly transferred to their brokerage in 1 hour?
Almost none. The time frame is intentionally punitive. It's designed for failure.
Precisely. If that wire transfer deadline is missed, and it usually is, the brokerage firm has a contractual obligation to protect itself, to protect its own capital.
They have zero choice.
Zero choice. They have to hit the sell button This forces the closure of your position, no matter the fundamentals, no matter how profitable the trade could have been long-term.
You're liquidated, often at a huge loss, because you were forced to sell into a temporary decline that you didn't even cause.
And here's the mechanism. This is what turns a simple rule change into a full-blown market crash. It's the liquidation cascade.
Right. All the forced selling from thousands of contracts from all these traders who just got margin called, they're all acting at the same time because they all face the same deadline.
And all that selling just drives the silver price down instantly.
And that sudden steep price drop, it triggers more margin calls for the next layer of leveraged traders.
The ones who had a little more cushion.
Exactly. The ones who had 21 or 22,000 deposited, now their accounts fall below the minimum threshold because of the price drop. So they too are forced to sell.
Driving the price down even further, triggering even more margin calls.
It's a self-fulfilling, engineered crash. Our source material is absolutely unequivocal on this. The fundamental value of silver did not change in that hour.
Nothing changed.
Only the leverage ratio and the liquidity you needed to maintain that leverage, it forced a market collapse by regulatory fiat.
The efficiency of it is it's horrifying. The goal is to flush out the retail speculator, the weak hands who are using maximum leverage.
And then transfer those incredibly valuable long positions instantly to the institutional players.
Strong hands. And who are they? They're the commercial banks, the bullion desks, the ones with effectively infinite liquidity.
Right. They can just sit back, watch the engineered crash happen, see the price drop to an artificial low caused by terrified, forced retail selling.
And then just sweep up all those contracts at a massive discount. All because the CME changed the rules in their favor. It's a clean transfer of wealth. It's not about superior trading skill. It's about regulatory control.
So that explains the how, the mechanism of the robbery. But to really prove intent, we have to know why. Why December 29th?
Was there a clock running down?
Exactly. Was there something that forced them to take this emergency action right then?
And the answer from the sources is a definitive yes. The timing is everything. And it all comes down to a massive structural liability the banks were facing because of options expiration.
This is where we move from the mechanics to the motive. This is the option wall.
Okay, so let's break down the financial architecture here. Options allow these huge long and short positions to concentrate at specific price levels. We call them strike prices.
And when you analyze the open interest data, that's the total number of outstanding contracts. What the data showed in late December was a gigantic, unprecedented concentration of call options right at the $75 strike price.
And a call option, just to be clear for everyone, it's simply the right to buy silver at a specific price. In this case, $75 on or before a certain date.
The expiration date.
If silver closes above $75 at expiration, those options are incredibly valuable. The sellers have to deliver the asset. If it closes below 75.
They expire worthless. The seller just keeps the premium they collected.
And the key detail, the one that really points the finger, is figuring out who sold all those contracts.
And our sources confirm it. It was the commercial banks, the very same players who were protected by the CME hike. They were the ones who wrote and sold these massive blocks of call options.
So they were betting the entire house that silver would not rise above $75.
It's their bread and butter. Pocket the premium. It's usually a low-risk income stream for them.
But then the price of silver started moving aggressively toward that $75 strike price. And the banks, they entered a state of imminent financial danger.
This is where it gets a little more technical, but it's critical. It's about delta hedging.
Right.
This is the operational reality of short-selling options. Delta measures how much the options price changes relative to the underlying asset. So as the silver price gets closer and closer to $75, the delta increases.
Which means their short position becomes more and more sensitive to price moves.
Explodes in sensitivity, and to mitigate that mounting risk to delta hedge, the banks are forced to go into the market and actually buy silver.
Wait, hold on. Let me make sure I'm getting this. The banks are massively short silver, but as the price gets close to their strike price, their own risk management systems force them to buy silver.
Exactly. They have to buy to neutralize their exploding delta risk. And that hedging action itself creates this immense, artificial, self-reinforcing buying pressure in the market.
So they were causing the rally against themselves.
They were. That's why the price action leading up to December 29th was so aggressive and fast. It was the short sellers themselves, desperately hedging, who were driving the price right towards that $75 wall.
And if silver had actually closed the month at, say, $80, The disaster for the banks would have been absolute.
Complete. The options would be in the money, and the banks would be on the hook to deliver a staggering amount of physical metal.
The sources estimate that liability was over 200 million ounces of silver, just from that one options wall.
And this is the vulnerability that threatened the whole system, because as we've talked about before, the banks don't have that physical metal. They operate a fractional reserve paper market.
So being forced to deliver 200 million ounces of physical silver, metal that just does not exist in their vaults.
It wouldn't just be a bad trading loss. It would trigger a catastrophic systemic financial event for those bullion desks. It could take them down.
They were facing a gamma squeeze.
A full-blown gamma squeeze. The delta starts changing so fast they can't hedge anymore, leading to this uncontrolled buying frenzy. They realize they're about to lose billions with only 48 hours left on the clock.
Well, so what do?
You don't take the loss, you pull the nuclear option. You get the CME, the referee you influence, to enact the massive margin hike.
And that regulatory intervention, that rule change, instantly crushes the leveraged retail longs.
Forces mass liquidation and smashes the price down to, say, $73.
And by guaranteeing the price closed below 75, every single one of those call options at the $75 strike expired worthless.
The danger just vanished. They saved themselves billions of dollars and the need to find 200 million ounces of physical metal, all with one swift regulatory action timed perfectly with 48 hours to go.
So the verdict is, it's just unequivocal. This was a defense mechanism against a massive losing short position.
It had zero to do with real market forces. It was the casino boss making sure the house always wins when the stakes get too high.
Okay, so we have the mechanism, the margin hike, and we have the mode of protecting that call wall. But to move this from a strong allegation to just hard evidence, we need proof.
We're due.
Proof that this crash was confined entirely to the paper market, that it wasn't rooted in physical reality.
And that proof, what our sources all call the smoking gun, comes from looking at the global markets. It's the Shanghai divergence.
This point is so important. It separates the market fiction from the physical fact.
It really does, because look, if the 11% crash was caused by a huge new silver discovery or a major electronics company saying they don't need silver anymore,
The price would fall everywhere.
it would fall uniformly across every major global exchange, London, New York, Shanghai, because physical commodities value is tied to its global supply and demand.
But that is absolutely not what the data shows.
Not even close. The contrast is stark. While the COMEX exchange in New York, the global center for leveraged paper futures, crashed 11%.
The physical price of silver in Shanghai, which is traded on the Shanghai Gold Exchange, or the SGE, it barely moved.
Exactly. The SGE is far more representative of real industrial physical bullion demand. So if COMEX plunged 11%, the price on the SGE might have dropped, what, 2 or 3%?
A tiny fraction. And this immediate difference is what analysts call the spread, the price difference between East and West.
And during this engineered crash, the spread between New York and Shanghai widened dramatically. We're talking several dollars per ounce in a very short period of time.
And the widening of that spread tells you everything. It tells you exactly where the selling pressure came from.
It confirms that the selling was purely paper liquidation, and it was concentrated on the leveraged exchange. If there was a genuine physical oversupply, the price in Shanghai would have collapsed by the same amount.
Think about who's involved. Who is forced to sell futures contracts because of a margin call?
Western speculators, people trading on the COMEX.
Right, and who's largely buying physical bullion or industrial metal for manufacturing.
The Eastern markets. China and India, who consume a huge percentage of the world's newly mined silver.
Our sources are clear. The traders and industrial buyers in China didn't suddenly stop needing silver for their factories.
Of course not. They just watched the artificial panic selling happening in the West, saw the COMEX paper price plummet, and immediately saw an opportunity.
They exploited the discount that was created by the forced liquidation.
And the Shanghai Gold Exchange is just built differently from the COMEX. It's heavily biased towards physical delivery. If the price dips on the SGE, it signals genuine softness in demand.
But if the price only dips on the COMEX,
It signals a technical failure in the paper system. The Shanghai divergence proved that the industrial demand, the physical scarcity, it was all unchanged. In fact, the Asian buyers were stepping in to buy the metal being artificially discounted by the Western panic.
And this brings up the idea of arbitrage. For savvy institutions, that sudden price difference between paper silver in New York and physical silver in Shanghai, That's a guaranteed profit.
Oh, absolutely. Arbitrageurs would instantly buy the cheap paper contract in New York and sell the more expensive physical equivalent in Shanghai. And that action is critical because it confirms the market is temporarily broken.
They're basically saying the low COMEX price is fake.
They're confirming it's fake, and they're working to close that gap. But the sheer size of the forced liquidation was so overwhelming, it just swamped the arbitrageurs for a little while. It allowed the crash to happen.
So the fundamental conclusion is solid. If it were a real supply glut, prices fall everywhere.
Right.
Since the price only crashed on the highly leveraged exchange governed by arbitrary margin rules, it concerns the event was a leverage problem, a paper problem, not a physical one.
The dynamic is it's the story of this market. The West is selling paper contracts subject to manipulation.
And the East is diligently buying the actual physical metal and taking it out of the system for good.
Right.
The divergence confirms it. While the paper price is easy to manipulate, the underlying physical value holds firm. Now, here's where it gets really infuriating, because this whole margin hike intervention, it's not new. This isn't some clever new tactic.
No. It is the oldest trick in the Wall Street playbook. It's the go-to mechanism when the short sellers are losing.
Our sources just kept saying, we have seen this movie before, multiple times.
And that repetition, that consistent playbook, it underscores the rigged casino analogy perfectly. If the house is losing, if the leveraged retail longs are about to bankrupt the short side, they don't take the loss.
They just change the rules.
They use the exchange's power to change the rule, instantly, to save themselves. And we have two vivid, high-stakes historical precedents that mirror this perfectly.
Let's start with the big one, 1980, the incident known as Silver Thursday involving the Hunt brothers.
Right. Nelson Bunker Hunt and his brother William Herbert Hunt, they decided they were going to literally try and corner the silver market. They were aggressively buying up massive amounts of physical silver and leveraged futures positions.
And the price just exploded. Through 1979 and early 1980, it eventually hit an all-time high of $50 an ounce.
Which was an existential threat to the commercial short positions held by the big banks. The leverage the Hunts were using meant that every single tick higher was creating enormous losses for the financial establishment.
So the exchange, in this case the COMEX, controlled by the CBOT, they panicked. They couldn't just raise margins gradually. The situation was too dire.
So they went straight for the kill switch.
This structural kill switch. They introduced something called Silver Rule 7.
And Silver Rule 7 was it was draconian. It was immediate. It essentially banned all purchasing of new silver futures contracts. You could only sell.
Wait, you could only sell?
You could only liquidate your existing long positions. Think about that market distortion. It was regulatory-induced one-way trading. The rule literally mandated that only sellers could participate.
That's not a market. That's a demolition.
It was demolition. It was a rule change designed to destroy the price and break the longs. Since the Hunts were holding these highly leveraged positions, and the market was suddenly flooded with forced selling.
The price collapsed.
It collapsed. Within days, it had fallen dramatically, leading directly to the Hunts' financial ruin and their bankruptcy. They were forced out of the game by the referee changing the rules right at the finish line.
And the lesson there was crystal clear.
Leverage is a double-edged sword, and the rules are controlled by the entity you're trying to beat. And apparently, the lesson was forgotten because we saw the exact same script play out again in 2011.
That's right. When silver rallied aggressively again, got up to nearly $49 an ounce, it once again threatened those big, entrenched commercial short positions.
So did the CME apply a reasoned, gradual margin adjustment?
No. Our sources confirm the exchange raised the required margin deposit 5 times in 9 calendar days.
5 times. In 9 days. That is the definition of targeted financial violence.
Think about the psychological strain of that. The financial strain on a leveraged speculator. It wasn't just volatility. It was a deliberate, rapid escalation of the cost to hold your winning position.
And in total, those hikes raised the cost of holding a position by an estimated 84% in less than 2 weeks.
And the result was predictable. The exact same thing. A massive cascading liquidation. The price crashed from $49 down to $33.
So the lesson from 1980, from 2011, and now from this December 29th event is brutal, but it's undeniable.
If you play in their casino, the futures and options market, they will not allow a leveraged squeeze to bankrupt their system. They will not be forced to cover their catastrophic short liabilities.
They will just make leverage unaffordable, right in the middle of your winning trade.
Which brings us to the psychological warfare aspect of all this. It's not just about the money. The money is the tool. The ultimate goal is to break the retail investor's spirit.
Let's really slow down and capture that feeling. Imagine you're that leveraged retail trader. You've been right for months. You've watched silver rally. Then you wake up to a 3 a.m. email from your brokerage.
That terrifying subject line, urgent margin call alert.
You log in, you see your account balance in severe red, maybe even negative, and you realize you have 60 minutes to wire thousands of dollars you don't have, or your position is gone forever.
The whole thing is designed to maximize that feeling of emotional capitulation.
Right. The internal dialogue they want to trigger is one of just crushing doubt and betrayal. They want you to think, I can't take this, I thought I was right, but this whole thing must be a scam, I'm selling everything, I'm getting out.
They want you to sell at the exact bottom.
At the exact bottom of the forced liquidation spike. Driven by fear, not by logic.
And that is the operational goal of a shakeout. They are shaking the tree as hard as they can to see which retail investors fall out. The crash is designed to maximize fear and force the exit of the weak hands using leverage.
And here's the harsh truth for anyone who sells into that engineered panic. If you sell now, after the crash has happened and the banks have already saved themselves, you are doing one thing.
You are voluntarily donating your position.
You are donating your valuable position to the very financial entities who engineered the crash. You are handing them your ticket to future gains at a massive discount because you let fear dictate your actions.
The key is to remember the fundamentals. The industrial scarcity of silver hasn't changed. The solar panels still need the metal. The vaults are still thin. The only thing that changed were the arbitrary rules of paper leverage and the desperate financial position of a few large short sellers.
Do not let their tactical use of power scare you into selling your actual asset. So, okay, we've recognized the market is rigged. We understand the weapon they use and we've seen the motive. Now we have to shift our focus entirely to empowerment, to actionable defense.
The informed player has a playbook for surviving this casino when the dealer starts cheating.
Exactly. And the defensive posture is everything. We know the fundamentals, the industrial scarcity, that hasn't changed. This engineered dip is just a temporary distortion. It is not a permanent impairment of value.
So the playbook is about inoculating yourself against the exchange's rule.
Playbook point 1, delete leverage. Our sources are absolutely emphatic about this. It is the foundational rule.
If you are using margin, borrowing funds, or using any kind of credit to trade futures contracts, you are exposed.
You are completely vulnerable to the rule change. You are subject to the CME's jurisdiction, and you can be liquidated whenever they want.
So the strategy for real security is absolute. You have to own the asset with cash, not with credit.
It has to be a 1-to-1 ratio. Cash for the asset, not 10-to-1 or 20-to-1. The only way to be completely immune to the margin hammer is to not play the leverage game at all.
If you hold the physical metal, they can raise margin requirements to $1 million an ounce. It doesn't matter.
It doesn't affect your ownership or your solvency one bit. You are outside their domain.
Playbook point 2. Buy the panic.
Yes. A forced liquidation cascade creates an artificial fire sale price. This is a temporary discount that is presented to you by fear, not by economics.
And while the paper price crashes, the premium you pay for physical silver, for things like sovereign coins, it might drop temporarily as that panic washes over the whole market.
That is the moment to act if you have the capital available. The smart money doesn't panic sell, they panic buy. Use this temporary distortion to acquire the physical metal that the leveraged speculators were forced to vomit up.
This engineered low, created by desperation, it's potentially the last good chance you'll have before the real industrial bid takes over again.
Playbook point 3, watch the open interest. So how do you know the shakeout is really over? How do you know the bottom is in?
You don't look at the price chart.
You don't. That just reflects fear. You look underneath the surface, you look at the open interest data. We learned that the primary job of the margin height is to reduce the total number of outstanding contracts.
So a drop in open interest is the market telling you that the mission was accomplished.
Exactly. It says the retail traders, the weak hands, they've been liquidated, they are gone. Once those leveraged contracts are closed, the downward pressure from the cascading margin calls, it just goes away.
A confirmed market bottom often aligns perfectly with the moment that open interest data shows the speculators have been flushed out. That's the signal.
That's your signal to re-enter or to add to your physical positions.
And finally, playbook point 4, hold the line.
This is the crucial psychological defense. The entire investment thesis for silver accelerating industrial demand, dwindling supply, currency devaluation, none of that changed on December 29th.
Physics and industrial scarcity will always win in the end.
A regulatory margin hike is a powerful tool, but it's ultimately a temporary financial manipulation. It cannot create more silver in the ground. It can't make solar panels run on promises.
It can only distort the price for a brief period. If you trust your core thesis, you have to hold the line, ignore the temporary price fiction, and let the undeniable physical reality eventually take over.
So let's bring this whole investigation to its final verdict. The 11% silver crash on December 29th was not a natural market event. It wasn't about supply and demand.
It was a manufactured liquidation event.
Designed explicitly and with devastating effectiveness to save the commercial banks from that massive multi-billion-dollar liability, the one posed by the impending $75 call wall expiration.
The margin hike was a desperate move, a tactical move.
Yeah.
And while the sting of that forced liquidation for retail investors using leverage it's really painful, the informed listener has to see the deeper implication here.
Yes, this manipulative move actually confirms that the underlying market squeeze is working.
Think about what that means.
Financial systems only resort to changing the rules, to using structural violence against their own players when they are truly losing, when their financial solvency is fundamentally at risk.
With their action, they proved it. They are scared.
And for those of you who hold physical silver, the core takeaway is absolute immunity. If you hold the actual metal, you are untouched. Margin requirements, regulatory changes, liquidation cascades, they are completely irrelevant to your asset.
You are outside the confines of their rigged casino, no matter what rules they invent next.
The ultimate protection in a system where the rules can change overnight is the direct ownership of the asset. The empire struck back, and they struck back viciously with the margin hammer. But in doing so, they revealed their profound weakness. They showed everyone how severe their paper short position really is.
And so the final provocative thought we want to leave you with is this. Use this engineered discount. This temporary artificial low created by desperate short sellers is fundamentally a gift.
It is likely one of the last chances to acquire metal before the undeniable industrial bid, driven by physics and permanent scarcity, takes over again and permanently reprices the asset.
The future belongs not to the owners of the paper contracts who are subject to the whims of the casino boss,
But to the owners of the actual asset, don't let their fear become your loss.